Hey guys, welcome back. This one's a follow-on video to the 12 stocks, 12 dividends or dividends every week for 12 weeks that I posted a few, probably a week ago now. There was a viewer that requested that we take a look at true earnings or real earnings after taxes and after inflation. So this was a little bit tricky to put together. I modified the existing spreadsheet and I'll have the Canadian side and the American side. Now, if you want to know for sure, you'll have to download the sheet and modify it with your particular tax brackets, because I didn't do all the provinces and all the states, or uh, rather all of the income brackets that could impact it. I'll go through a few variations in the video here, but you might have to do a little bit of research to find out what those numbers would mean for you if you're not in the same area that I'm at, or if the numbers don't match. So here we go. So as you can see, the sheet is relatively the same as it was. I did add a company name column as well as the exchange. Some people were having a hard time finding the tickers and matching them with the price. So this should help for everybody. I moved the monthly returns, or the calculation for January, February, and so on. It was below before. Now it's over on the right hand side, a little bit out of the way. You might have to scroll like me, depending on what size monitor you're on. But then if we go a little bit below here is where the fun happens. So before we take a look at these, I want to stop and talk about eligible dividends versus non-eligible dividends. You'll see, if you do a little bit of research, you'll see this come up. Eligible dividends are normal dividends that you get from the stocks that you buy on an exchange, publicly traded stock. Non-eligible are typically dividends from a small private business that isn't taxed very high, and the owners, or private shareholders, might pay themselves a dividend in lieu of a salary at the end of the year based on the profits. That tax rate will be quite a bit higher because the corporation is on a lower tax bracket. In this case, we're not going to explore that one. I'm going to stick with you're buying stocks from known exchanges like TSX, New York Stock Exchange, NASDAQ, and so on, and that you are buying stocks that are eligible. So, by the way, on the second sheet here, I put in a couple of useful links if you want to go back and do your own reading on what tax rates are and so on. Just on the second sheet, you'll have it there. So here we have it. For the US, you have a federal tax rate, and I should rewrite this to state, not provincial. Sorry. And no state taxes that I could find for the most part, but if you do happen to have one, please go ahead and put it in there. The field is there and working for you no matter what. So the 15% here, it could actually be 0 or up to 20, and it is based on how much income you have. So if we take a look here, you can see, and this is one of the links I shared. So if you're below an income of 44,000, you'll have, that's if you're filing single, you'll have 0% taxes. Head of the household is 59,000, and then married filing jointly might be up to 89,000. For anyone above those, again for qualified dividends, for above those incomes, depending on how you file, you'll have 15% tax on your dividends. And then if you're higher than 276,000, again, depending on how you're filing, it could go up as high as 20%. So over here, I had put the 15 rate. I assume most viewers will be in that rate. So you can see that if I had invested 12,000 in capital across 12 companies, so 1,000 in each, my yearly total in dividends would have been $1,378.02. The tax on this would be $206.70, leaving me with a real return of $1,171.32. From there, we still have to take into account the inflation rate, and that's your second box below. So I put an average inflation rate for the period at 4.5. I didn't particularly research this. You can play around with higher or lower depending on what you're looking at, as it is a variable. So when you apply inflation, that means the purchasing power, even though you still have the number 1,171.32 in your bank account, the purchasing power is closer to 1,120 and 88 cents. So your initial investment's purchasing power, because don't forget the 12,000 you originally invested, it's also going to suffer potentially from inflation, assuming it does not appreciate. Okay, in this formula here, we assume that the stocks themselves didn't appreciate, and you were getting all the payout as dividends. So your purchasing power would become 12,604, which is not great, but I would assume that the actual growth rate of these stocks will not be zero. It's probably going to be more around 4.5%. So again, these are moving parts. You can set your taxation rates, you can set the inflation for the period, and then even though this sheet doesn't calculate the growth in the value of the stocks, you could still factor that in later. Now, that's for the US. For Canada, it's a little bit different. We have a federal tax and a provincial tax on dividends. Here I have the one for Quebec. So you can see for eligible dividends for, here we go. For Quebec specifically, under this income, it's 14%, right? And then we have different brackets depending on how much you made. So you have to calculate it in slices, and I apologize, I didn't venture forward into complexifying the formula if you were earning more. Maybe I will in a future date. And then the federal one, again, at least the numbers match. I'll give them that. But the federal one for eligible dividends would be 3.15. So coming back here, we've got our 3.15 for federal and our 14 for the provincial tax. So that's 43.41 for one of them and 192.92 for the other, leaving a net after tax of 1141.69, which is not bad. And then if we apply the inflation, it drops to 1,092.53, and then the investment on the initial purchasing power and your return would be 12,575.78. You can see in Canada we get taxed a little bit differently and a little bit more than in the US, and that is pretty much the case across the board no matter what. And so there you have it. I'll polish off the spreadsheet, and you guys can download it as you need. All right, there you have it. Real returns over a 1-year period of investing or having invested $12,000 into 12 different stocks, 1,000 per stock. As you can see, even with taxes and inflation, you're still coming out ahead, although not necessarily as much ahead as it would seem. And also, for there to be taxes, there has to be profits. So keep that in mind. Yeah, it sucks that you're getting taxed, but it's a sign you made money at the very least. Now, inflation, depending on how high it varies, could knock this into a negative return situation where the money you invested and the money you got back at the end of the year is still worth less than that money was, 12 months before. But that's not a side effect of dividends specifically. It's really the inflation that's the problem at that point. Dividends are just essentially profit sharing. Can be dividends without profits. That's a whole other story. But the spirit of the dividends is, as a fractional shareholder, you're getting a fraction of the profits at the end of the year. So let me know if you have any questions in the comments, and I'll try to actually include real returns into more of my videos going forward. Thanks for watching. Please subscribe.